Welcome back to the deep dive. We've got a really interesting set of sources today.
Yeah. What are we digging into?
It's all about accounting policies, errors, estimates, the nitty-gritty under IFRS and US GAAPs.
Ah, okay. Foundational stuff. Sounds maybe a bit dry.
Well, it could be, but understanding this is like key to really reading financial statements, isn't it?
Absolutely. How a company picks its rules, fixes mistakes, deals with uncertainty. It tells you so much, sometimes more than the big numbers themselves.
Exactly. It's like the grammar behind the language of finance. So you've shared these sources, and our plan is to unpack them, pull out the core insights.
Right. We'll look at definitions, what happens when things change, and really focus on the similarities, but also some pretty surprising differences the material points out.
We're basically going to guide you through what these sources reveal, hitting the most important points.
Sounds good. Where do we start?
Okay, first things first, definitions. What exactly are accounting policies or principles?
Well, the sources are reassuringly similar here. IFRS calls them accounting policies.
Right.
US GAAP often uses accounting principles, but the meaning, it's basically the same. Your sources define it as the specific principles, bases, conventions, rules, and practices a company uses for its financial statements.
So different label, same idea. The ground rules. Got it. But what if the rule book is silent? What if there's no specific IFRS standard or, US GAAP section for something?
Ah, good question. That's where judgment comes in, but it's not just make it up as you go. There's a hierarchy.
Okay.
Under IFRS, management first looks at guidance for similar issues within IFRS itself.
Makes sense. Stay close to home first.
Yeah. If nothing's there, they go to the IASB's conceptual framework, the fundamental concepts. Your sources also say they can look at other standard setters or industry practice.
But there's a but.
Yes, a big one. Only if it doesn't conflict with IFRS or the framework. They're pretty strict about staying within IFRS ecosystem if possible.
Okay. IFRS keeps it tight. What about US GAAP and the codification?
So the codification is king, obviously. If it's silent, they first look for analogies within the codification.
Still staying internal.
At first, yes. But then your sources highlight something interesting. The non-authoritative guidance they can consider is, well, broader.
Broader how?
It includes things like FASB concept statements, but also, and this is quite notable, your sources say it can even include IFRS standards.
Really, US GAAP allows looking at IFRS if the codification is silent.
As non-authoritative guidance, yes. It's quite a contrast to the IFRS approach, like you said, almost a nod across the pond.
Ah, different philosophies there. Okay, so once a policy or principle is chosen, consistency is key, right?
Absolutely. You stick with it for similar things, period over period. That's crucial for comparability.
You need to compare apples to apples.
Exactly. But here's where your sources flag a really surprising difference, especially in group reporting. Consolidation.
Oh, what's that?
Okay, so for subsidiaries you control and consolidate, both frameworks generally want consistent policies. That makes sense.
Yeah, you want the group numbers aligned.
Right. But for equity accounted investees, those companies where you have influence, not control, IFRS says the investor must make sure the investee's policies are consistent with its own when applying the equity method. You basically conform their numbers to your IFRS policies.
Right, so the share of profit you pick up reflects your accounting choices. What about US GAAP?
This is the surprise. Your sources state that under US GAAP, while consistency is generally encouraged for consolidation,
Generally.
equity method investees may use different accounting policies. The parent isn't necessarily required to conform the investee's policies.
Wow, hold on. So under US GAAP, the profit share coming in from an investment could be calculated using totally different rules than the parent uses itself.
That's what the sources indicate, yes. It's a definite difference in how far that consistency principle extends.
That feels like it could really affect comparability, even within one company's reports.
It introduces a variable, for sure. Okay, so policies are set. When can they actually change?
Two main reasons, I guess. A new rule forces it, or the company chooses to.
Exactly. If a new standard mandates it, well, you just follow that standard's transition rules. Easy enough.
But for a voluntary change.
Under IFRS, the new policy has to provide information that's reliable and more relevant.
Okay, higher quality info.
And under US GAAP, the new principle must be preferable.
Preferable. Different words again. Does it mean the same thing in practice?
Your sources suggest probably, yeah. Significant differences aren't generally expected just because of the wording. The bar is high. Either way, you need a good reason. It has to be a genuine improvement.
Not just window dressing.
Right. And How do they tell us about these changes? Disclosures, obviously.
What do they need to say?
Both need you to explain the change, why you did it, why it's more relevant, reliable, or preferable. But US GAAP has an extra step, specifically for SEC companies making voluntary changes.
Oh, yeah. What's that?
Your source can highlight this. Domestic SEC filers need a letter from their auditors. It's often called a preferability letter.
A letter from the auditors saying the change is okay.
Essentially, yes. Confirming the new principle is preferable. It gets filed as an exhibit with their next 10Q or 10K.
Huh. There's a very specific US GAAP SEC thing. Adds another layer of, well, scrutiny.
Definitely. It's a hurdle. Now, speaking of big differences, your sources point to a massive one impacting the balance sheet. Asset revaluation.
The IFRS revaluation model. I know this one.
Exactly. IFRS allows companies, as a policy choice for certain assets like PPE or intangibles, to revalue them upwards to fair value.
So assets can go up in value on the books, not just down through depreciation or impairment.
Correct. But the key difference your sources stress is US GAAP does not permit this revaluation for those assets.
No upward revaluations under US GAAP, period.
Right. They stick primarily to historical cost less depreciation and impairment.
That is a fundamental divergence. The same company could have a very different looking balance sheet, different equity value depending on which standard it uses.
Absolutely. Huge impact on book value, related ratios. It's a biggie. Okay, so policies change. How is the change actually put into the numbers?
Retrospectively, usually.
Generally, yes. Retrospective application, meaning you pretend the new policy was always there.
Like going back in time and rewriting the financial history?
Pretty much. You adjust opening equity for the earliest period shown, and you restate the comparative figures, income, assets, liabilities, everything for all prior periods presented, including tax effects.
That sounds like a lot of work, making the past line up with the present.
It is significant, and that's the rule unless it's impracticable.
That word again, impracticable. We'll come back to that.
Definitely, because it's crucial for another difference. But first, let's talk errors. Actual mistakes. What counts as an error?
Miscalculating something, applying a rule wrong, missing facts.
Exactly. Your sources say both standards define them similarly. Misapplication of policies, overlooking or misinterpreting facts that existed in a prior period when those statements were issued. Think math mistakes, applying GAAP wrong, even fraud.
Okay. And if you find a material error from a prior period,
you correct it by restating the comparative information. This brings us to the term restatement.
And there's a slight language difference here too, isn't there?
It's a subtle one, yeah.
Here.
Your sources mention IFRS uses restatement a bit more broadly, could be for a policy change adjustment or an error correction.
Just means adjusting the comparatives.
Right. Whereas under US GAAP, restatement usually signals an error correction specifically. They might use retrospective adjustment for policy changes. It's just a nuance in terminology.
Good to know. US GAAP restatement likely means, oops, we made a mistake. IFRS restatement could mean that, or just a policy change.
Generally, yeah. Now, back to impracticability. You mentioned it as an out for applying policy changes retrospectively if it's just too hard.
Right.
Does that same out apply to correcting errors? This is where your sources highlight a really key divergence.
Okay, tell me.
First, what is impracticable? The rule itself is similar in both. You can only use information that was actually available or reasonably could have been obtained and considered back when the original transaction happened. Evidence of circumstances back then.
No hindsight allowed. You can't use what you know now to judge the past.
Exactly. Crucially, no hindsight. Now, the big difference. Under IFRS, this impracticability exemption applies to both policy changes and error corrections.
So if fixing an old error perfectly is genuinely impossible using only past info, IFRS gives you an out. You adjust from the earliest possible point.
Correct. It acknowledges practical limitations, but under US GAAP...
Let me guess. No out for errors.
Bingo. The impracticability exemption applies only to changes in accounting principle under US GAAP. It does not apply to correcting material errors.
Wow. So if you find a material error under US GAAP, you have to restate the prior periods if it's at all possible using the information available then. Not too hard excuse.
That's the gist of it. It's a much stricter requirement for correcting the historical record when it comes to material errors. Users get more assurance that past numbers are fixed if they can be.
That makes sense. It feels like a stronger stance on historical accuracy.
It does, and your sources also mention specific US GAAPSEC terminology here. Big R reratements or reissuance for errors so bad the old financials can't be relied on.
Need to reissue them.
And little r restatements or revision for errors not material to the past but material if uncorrected now. You revise the comparatives next time. Plus voluntary revisions for immaterial stuff.
Big R, little r. More granularity in US GAAP, especially from the SEC side, about how bad the error was.
It communicates the severity more explicitly. Okay, shifting gears. Accounting estimates. The third bucket.
Things involving judgment, uncertainty.
Right. IFRS defines the monetary amount subject to measurement uncertainty. Think bad debt allowances, warranty provisions, asset useful lives.
Makes sense. US GAAP.
Your sources say US GAAP doesn't actually define accounting estimates specifically, but practice is expected to be similar. Changes happen when your assumptions or measurement techniques change new economic data, different usage patterns for equipment.
So you're updating your best guess based on new info, not changing the whole accounting method.
Yeah.
How are these changes handled?
Agreement here. Both standards say changes in estimates are accounted for prospectively.
Prospectively, meaning only in the current period and going forward.
Exactly. No restating past numbers. You reflect the change now and in the future. Big contrast to policy changes and errors.
That seems logical. You learn something new, so you apply it now. But what if it's fuzzy? Hard to tell if it's a policy change or just tweaking an estimate.
Good point. Your sources say if it's difficult to distinguish, both standards treat it as a change in estimate.
When in doubt, go prospective. Seems practical. Any US GAAP wrinkle here?
A small one. Unlike IFRS, your sources note that US GAAP still requires you to show preferability for these hard-to-distinguish changes treated as estimates.
Ugh, that preferable standard again. Even when treating it as an estimate, they want justification if it smelled like a principal change. Consistent theme for US GAAP.
It reinforces that need for justification.
Right.
Okay. Disclosures about judgments and estimates. Both require them, yes. Under IFRS, you disclose significant judgments made in applying policies and key assumptions or uncertainties that have a high risk of causing a material adjustment next year.
So the big judgment calls and the really sensitive numbers.
Yeah.
US GAAP.
SEC registrants discuss critical accounting policies and estimates. Similar idea, but your sources point out this is usually in the MD&A management's discussion and analysis, which is outside the audited financials.
Ah. Different location.
Yeah.
IFRS is usually in the notes to the financials.
Generally, yes. All US GAAP entities, SEC or not, must disclose estimates that could reasonably change materially soon, similar to the IFRS uncertainty disclosure. But your sources indicate non-SEC US GAAP filers don't have that specific IFRS requirement to disclose significant judgments in applying policies, and their overall estimate disclosures tend to be, well, less detailed.
So potentially less transparency around judgments and estimates for non-public US GAAP companies compared to IFRS or SEC filers. Another difference in the level of detail you might get.
It can be, yes. Okay, briefly. Changes in classification or presentation, just moving things around on the statements.
Does that need retrospective treatment too?
Generally, yes. Both require restating comparatives so they match the new presentation, apples to apples again, and disclosures explaining why.
And if it's tied to a voluntary policy change?
Then under IFRS, that policy change needs to provide more relevant info. Under US GAAP, it needs to be preferable. And if the reclassification is actually fixing an error,
then error correction rules apply.
Got it.
Consistent logic.
Yeah.
Now, your sources mentioned a very specific presentation difference, something about a third balance sheet.
Yes, this is a clear divergence. Under IFRS, if you make a material retrospective change, policy, error, reclassification, you have to present a third statement of financial position.
A third balance sheet. When?
As at the beginning of the preceding period. So if you show 2025 and 2024 comparative, and made a material change affecting 2024, you also show the balance sheet as of January 1st, 2024.
Okay, so it gives a clear starting point before the retroactive adjustments hit the comparative year. What about US GAAP?
Here's the stark difference your sources highlight. US GAAP does not require this third balance sheet at the beginning of the earliest comparative period ever.
Never required under US GAAP. That's a really concrete difference in what you physically see in the report.
It absolutely is. Impacts the layout and the historical view presented. Okay, a couple more quick comparative things. Business combinations. Buying companies. Generally no restatement of past consolidated financials for buying or selling subs unless it's a discontinued operation. Both agree there.
But common control transactions. Moving companies around within the same group.
Ah, yes. Another specific difference from your sources. Under IFRS, the acquirer may choose to adjust comparatives. It's an election.
Optional under IFRS.
Under US GAAP, the acquirer is required to adjust comparatives retrospectively.
Mandatory under US GAAP.
Yeah.
Okay. And what about a change in reporting entity? Like starting to consolidate when you didn't before?
Your sources say IFRS is actually silent on this specific concept, but US GAAP has rules. Prior periods are adjusted retrospectively for a change in the reporting entity.
So, US GAAP addresses it directly, requires retrospective adjustment. IFRS doesn't have a specific rule for that label.
Correct. Though your sources clarify that normal acquisitions or consolidating VISBs aren't considered a change in reporting entity under either standard, those have their own rules.
Got it. Okay, last area. New standards that are issued but not effective yet. Do companies have to warn us?
Yes, both require disclosures about issued but not yet effective standards. Give users a heads up.
What info?
The basics, what the standard is, what it changes, when it's effective, when the company plans to adopt, and crucially, the expected impact or a statement saying they don't know the impact yet.
So, core info required by both. Any US GAAP specifics, especially SEC.
Yes, for SEC registrants, your sources say they must disclose the transition method chosen, if they've decided. And this is interesting, they're encouraged to discuss other potential significant impacts.
Other impacts? Like what?
Things like maybe effects on debt covenants, or even if they'll need to change business practices because of the new rule. It's broader than just the accounting effect.
Encouraged to give more context under US GAAP Sec. That feels very SEC-like.
It does, and your sources note this disclosure is required for SEC filers, but not required for other US GAAP entities, though it's best practice. Under IFRS, it's a general requirement for everyone.
So again, potentially less foresight for users of non-public US GAAP financials compared to IFRS or SEC filers.
It's another potential gap in transparency, yes.
Wow. Okay, we have covered a lot of ground, really digging into the details from your source material. Definitions, changes, errors, estimates, presentation.
And pulled out some really key differences, didn't we? Equity, investee consistency, that preferability letter, the whole revaluation debate, how impracticability applies differently to errors, the third balance sheet, calming control, upcoming standards, disclosures. It adds up.
It absolutely does. It makes it really clear that the choice between IFRS and US GAAP isn't just cosmetic. These rules for handling change and uncertainty, they can genuinely lead to different numbers and different levels of disclosure.
They really can shape the story the financials tell. So, based on all this detail from your sources, here's something for you, the listener, to think about.
Okay.
Given these sometimes quite subtle, sometimes very fundamental differences in how changes, errors, and estimates are handled and reported under IFRS versus US GAAP, how might a company's choice of standard affect how easy or difficult it is to truly compare its performance and position over time? Or, maybe more importantly, compare it against a competitor using the other set of standards?
That is definitely something to mull over. Great stuff. Thanks for joining us for this deep dive.